Chapter 6, Lesson 2 is on renting or owning a home. There are costs involved in home ownership, such as property taxes, school taxes, repairs, maintenance and utilities and insurance, and other services such as trash pickup. Two other expenses are depreciation and the loss of income on the money invested in your home. Depreciation is the loss of the value of the property caused by aging or use. Parts wear out, such as the roof. Home styles may change, such as popcorn ceilings that used to be in style. Now people don't like them, so they'd have to take that down. Or if home becomes too expensive to heat or cool, as energy costs rise. Most homes depreciate slowly at about 1 to 4%. Loss of income happens. Now this happens because when you put that down payment down on your home, you can't get an interest for that money that you're using to buy the home. Equity. Equity is the difference between what is owed on the property and its value. So for example, if you have a $100,000 home and you pay for a while and then you owe $60,000, the difference between $100,000 and $60,000 is your equity in the home. So you have $40,000 worth of equity in that home, meaning that if you sold it for $100,000 and you only owe $60,000, you get the profit for that equity. Homeowners can deduct the interest paid on their mortgage and property taxes from their income tax or income tax form. So if you itemize your income tax, you can deduct that property taxes and your interest that you paid on your tax form. Example 1, the Hansons want to buy a home. The interest they will pay on their mortgage for the first year is $5,244. The annual property taxes on the home are $2,350. An insurance policy on the home is $360 a year. They estimate their home will depreciate $1,240 in the first year. Utilities are $1,710. Maintenance and repairs are $1,535. They lose $1,270 in interest on their down payment. They estimate that they will save $1,428 on their income tax in the first year because the mortgage interest and property taxes will raise their itemized deductions above the standard deductions allowed. What will the net cost of owning the home the first year will the Hansons have in the first year? So we're going to figure out all their expenses that they have and then add back to that the income tax break that they get. So first of all, let's add up all the expenses. So number 1 example. So first we have the interest. And the interest is $5,244. Then the next thing, if you're reading along, it says property tax. Property tax is $2,350, which they have to pay every year. Insurance. Insurance they're paying on their home just in case something happens. The door, somebody runs in your garage door, or unfortunately if you have a fire, $360. Depreciation. $1,240. Utilities are $1,710. Maintenance / repair, $1,535. And lost income for the down payment is $1,270. We're going to figure out all these expenses. We're going to add them all up. And when you add these all up, you get $13,709. But we do get that tax break on our income taxes so that we can add that or subtract that out of these expenses. So we're going to subtract that $1,428. Again, that's our tax break. So our expenses, net expenses or net cost is $12,281 is the net cost for owning the home for the Hansons. Next, let's talk about cost of property rental. Now, when you rent a property, you have to pay your rent every month. You also have to pay usually like a down payment, and they can either keep that down payment or they give it back to you depending on how you keep up the apartment. It might be have trouble predictable housing costs because some things go up and down. Usually not your rent. Usually it's a set fee for a certain year amount of time, and then they could raise the rent after the year's over, your lease is over. You don't have to worry about, however, you don't have to worry about fixing things. So if your refrigerator gets broken, you just call up your maintenance person and they have to either fix it or replace it. It's up to the landlord. There's some disadvantages there's federal income tax benefits. You don't get that. You don't build equity in your property because it's not your property, so you're not building equity. Again, the security fee, if you don't, if you have damages, they're going to take that, or you can keep it depending on how you keep the property. Maybe higher rent if you have a pet. Whereas if you own your own home, you can have a pet and it doesn't cost you any more. So let's look at example 2. It says Mary plans to rent an apartment for $710 a month, including heat and water. The security deposit will be 1 month's rent. She estimates that her other annual costs connected with the apartment will be insurance $110, utilities $600, covered parking space $240. What is Mary's first year cost of renting the apartment? So they want to know the total cost of renting for the year. Example 2. First of all, we have to figure out how much her rent is for the full year. Each month is $710, or 12 months in a year, so we got to multiply it by 12. And we get a total of $8,520 in rent. That's her first fee or expense. Security deposit, $710. Security. Another expense is insurance, $110. Even though she is renting and the house is not hers, all the property inside the house is hers. So if she doesn't insure it and there's a fire or there's some kind of damage, she's not going to get anything back the homeowner or the landlord does not pay for that. $600 in utilities. $240 for the parking space. So if we add all those expenses together, we get a total of $10,180. That is the total cost for renting for the first year at this apartment. Now, that money, she's not going to get anything back. She doesn't build up equity. It's just gone, but she gets the privilege of living there for the year. So that's that one. Next. Comparing renting to owning. So some people have to decide, is it better for me to rent or should I own my own house? What is the benefit? Will it cost me less if I rent or cost me more? So you can compare buying a house to renting a similar house. In example 3, it talks about that Cedric has $17,000 he can use as a down payment on a house that sells for $85,000. The interest for the year on his mortgage would be $5,184. He estimates his property taxes to be $1,720. Other costs of home ownership would be $3,270. He would lose $680 interest on his down payment and closing costs, but he would save $895 on his income tax. So we have to add up all the expenses, but then subtract out the income tax benefit. Now remember, even though he is he's estimating all these costs, things can happen when you own your own home and you can't account for that, and you just have to replace. If your well runs dry, you have to dig a new well. If your hot water heater breaks, you have to fix that. So some of the things, you know, he's estimating. This is not a set in stone amount of money. But let's see what else it's saying. So it says that he can rent a similar home for $850 a month with a security deposit of $1,200. His other annual expenses of renting would be $130 for insurance, $1,400 for utilities, and then they're asking, is it less expensive for him to buy or rent a home? What is the difference? So we have to figure out owning versus rent. We're going to figure out the difference between the two. Let's start with owning. What are the things that we have to pay for? Well, the interest that he paid, which was $5,184. That's the interest. Plus, we have the property tax, $1,720. Plus, we have the other $3,270. Maybe he's accounting for if something breaks. Plus the $680 on the loss of income. But again, we get that tax break, so we're going to subtract that out of $895. Gives us a total for owning our home for the year $9,959. Again, remember, when you own your own home, that's going to be equity that you have into the home. Once you think about, you're putting money in and you're going to get something back at the end. Where again, renting, you don't. $850 a month for renting times 12 months gives us $10,200 for the rent. That's the rent. Plus, we also have security deposit, $1,200 security. Plus, you have your other, which is $130, plus the utilities. Now, utilities, again, we're talking about electric, water, heat. Gives us a balance of $12,930. They want to know the difference, and they want to know which one is less expensive. So we're going to subtract to find the difference between the two. And obviously, just looking at these numbers, owning is less expensive. Minus the $9,959. When you subtract it, you get $2,971, and you can say it's less expensive to buy. Keep in mind that if something happens and you need to fix something when you're owning your own home, you can't just call a landlord and say, come fix it. You have to fix it on your own. So even though it says it's less expensive to buy, it may not always be the case. So this is the end of the notes for section 6.2. Now I would like you to go to your next page, which is page 11 in your packet. And you're going to do the assignment 234, questions 10 through 15. Please have them done and submitted on time to me by email, or you can text me. But have those turned in on time, and then the next video I will go over these examples. As always, be safe, stay home, don't drive your parents crazy. We do miss you, and we'll talk to you soon. Bye.